Okay, welcome. Today, we're strapping in for a deep dive into some pretty high-stakes finance. We're looking specifically at the London Stock Exchange and its strategic effort to really claw back its position on the global stage.
That's right. We're analyzing what's being called the London IPO revival strategy. And, it's clear from the get-go this isn't just some abstract financial maneuvering.
No, definitely not. This feels urgent, like a high-budget, high-level battle, really. It's about where the next generation of global tech companies are going to choose to list their shares.
And the urgency, it comes from a place of, well, necessity. The LSE has been losing ground. That's the painful reality here.
Losing ground specifically where it hurts most, right? Those big, lucrative tech listings.
Exactly. The marquee names, the ones that bring innovation, liquidity, they've been going elsewhere. Think New York, NASDAQ, even Amsterdam showing up more.
And this isn't just about market share percentages either, is it? This ties into the bigger picture for the UK, especially post-Brexit. National financial positioning seems to be at stake.
Absolutely. The strategy is explicitly framed that way, keeping the UK competitive as a major finance hub after leaving the EU. The stakes are, well, quite high. It's more than just the LSE itself.
So we're going to break down what they're actually doing, the regulatory changes, why founders were pushing for them, and crucially, what all this might mean for you, the retail investor. Okay, let's unpack this.
Sounds good. So the first thing to really grasp is that problem you mentioned, the LSE losing those big tech listings. It's not just a perception. The source materials make it clear this was happening demonstrably.
Right. So why? Why were these huge, innovative companies looking past London? You mentioned New York.
Yeah, and it often boiled down to one key thing: control. Founder control.
Ah, okay. That makes sense.
The sources really highlight this. London traditionally had this quite strict adherence to a one share, one vote governance model, very egalitarian in theory.
But not what tech founders necessarily want.
Not typically, no, especially those coming up through the U.S. venture capital system. They're often, well, let's say, very keen on maintaining control even after going public.
And that's where London's rules became a barrier.
Precisely. Think about ARM, the big semiconductor company. Huge UK tech success story.
Right, and they chose NASDAQ in New York for their big listing, not London.
Exactly. And according to the sources, that decision was a massive blow, a sort of public signal of a competitive failure for the LSE. It really seemed to accelerate this whole regulatory rethink.
Because it showed that potential future growth, AI, biotech, software companies might just bypass London entirely.
That was the fear, yes. That ARM was a data point, maybe an expensive one, showing the direction of travel. Founders wanted something London wasn't offering.
Which was this concept of dual-class shares.
Yeah.
DCS.
Yes, dual-class share structures. For anyone listening who isn't familiar, it's quite important to understand.
Break it down for us.
Okay, so basically a DCS allows founders, maybe early management too, to hold a special class of shares. These often come with super voting rights, say 10 votes per share compared to just one vote for the shares offered to the public.
So the people who started the company keep disproportionate control over decisions, even if they don't own a majority of the equity anymore.
That's the essence of it. And London, for its main premium listings, effectively banned these structures for a long time, which, immediately put it out of the running for many of those US-style tech firms.
So the revival strategy, in large part, had to tackle this specific issue head-on. It was about catching up to the U.S. model, in a way.
It seems that way, yes. The need to stop the bleeding, as you put it, led directly to the how. They had to change the rules.
Right, because just saying, hey, we want IPOs doesn't work. What concrete steps did the UK take? What regulations changed?
Well, the big catalyst, the foundational blueprint, really came from the Lord Hill Review. This was commissioned by the government. And it wasn't just suggesting minor tweaks. It was pushing for quite significant regulatory liberalization. The stated goal: make the UK the most attractive place in Europe for companies to list.
Ambitious. So what came out of that review?
Sweeping changes followed. The most prominent, perhaps, was giving the green light to those dual-class share structures we just talked about. Basically giving founders what they were asking for, at least for an initial period post-IPO.
So check one box for founder control. What else?
They didn't stop there.
Is it
The LSE also slashed the minimum free float requirement.
the free float? That's the percentage of a company's shares that have to be available for public trading, right?
Exactly. Traditionally, for a premium listing, it was 25%. They cut that drastically down to just 10%.
Wow. Okay. That's a huge shift. What's the implication there?
It makes listing much less burdensome or perhaps less dilutive for the existing owners and founders. They have to sell off a smaller chunk of their company when they go public.
But it also means fewer shares are immediately available for trading by the general public and institutions when a company lists.
That's the flip side, yes. Less immediate public availability. It's another signal that they're prioritizing making listing easier for the companies themselves.
Interesting. Any other big rule changes?
Yeah, they also overhauled the rules for SPACs, those special purpose acquisition companies.
Ah, the blank check companies. They had a moment, didn't they?
They certainly did, although the global boom has cooled off quite a bit. But London wanted to be competitive there, too. They relaxed rules around things like share suspensions when a SPAC finds a target company, trying to compete with places like Amsterdam, which had actually snapped up quite a bit of that SPAC activity, especially post-Brexit.
So across the board, DCS, lower free float, easier SPACs. It sounds like a concerted effort to make the rule book much more company-friendly, perhaps even founder-friendly.
That seems to be the clear direction, a willingness to adopt more modern, some might say potentially riskier, listing structures and requirements to win back business.
Which highlights a really interesting trade-off, doesn't it? London's reputation was built partly on having quite rigorous standards, strong investor protections.
Historically, yes, seen as a gold standard in some ways.
And now it seems they're consciously deciding to relax some of those standards. They're saying, okay, we'll compromise a bit on shareholder governance rigor in exchange for getting these high-growth tech companies the volume, the prestige.
That does seem to be the calculation they've made.
Which brings us directly to the payoff part. We've talked about the why losing listings, post-Brexit pressure, and the how the rule changes like DCS and free float. But what does this actually mean for, the average person listening, the retail investor?
This is where it becomes very tangible.
Right, because regulatory changes can sound quite dry and technical, free floats, SPAC rules. But the core idea here is that the LSE is actively working to attract these companies back to London.
Exactly. And if they succeed.
Then the direct consequence, as the sources point out, is that retail investors could see new IPO opportunities.
Precisely. That's the key takeaway for the individual investor. It connects that high-level national strategy directly to potential opportunities for personal wealth creation.
Can you elaborate on that? How does a London listing make it easier for a UK retail investor compared to, say, ARM listing on NASDQ?
Well, when a major company lists overseas, accessing those shares as, say, a UK-based individual can be complicated. You might need a specialist broker. You're dealing with currency exchange risk, sometimes higher fees. It's just fiddlier.
Okay.
But when they list domestically on the LSE, those hurdles largely disappear. You get direct, straightforward access through standard UK brokers to invest in these companies right from the IPO stage, potentially capturing early growth if the company does well.
So the LSE isn't just trying to attract big institutional money anymore. They seem to recognize that the retail market, individual investors like you listening, are now a really important part of making any listing successful, providing that liquidity.
It certainly looks that way. It feels like a shift. The retail investor, maybe once an afterthought in the IPO process, is now seen as part of the solution to making London attractive again. Empowering the domestic investor base helps create a vibrant market.
But hang on, there's a tension here, isn't there?
Yes, definitely.
We've got this dual benefit. The UK potentially boosts its financial center status, and individuals get easier access to IPOs. Great. But how did we get here? By relaxing rules, specifically by allowing things like dual-class shares.
Which, as we discussed, give founders more control and potentially less accountability to public shareholders.
Exactly. So the big question becomes, how does the exchange manage this? How do they balance attracting these companies who clearly want less scrutiny and more founder control with ensuring that the IPO opportunities offered are actually good quality, well-vetted, and ultimately beneficial for the retail investors they're trying to bring into the fold?
That is the critical tension, and the sources do suggest there's considerable skepticism among some traditional city investors about how quickly these rules were liberalized.
They're worried about quality control.
Essentially, yes. The worry is that in the rush to attract volume, the quality of the company's listing might drop, or that the reduced governance standards mean retail investors are less protected if a company underperforms, or worse, if something goes wrong. The classic fear of being left holding the bag.
It sounds like a real tightrope walk for the LSE. They need the listing volume to show the strategy is working and regain that global relevance.
But they can't afford scandals or a string of flops that would destroy the trust of those very retail investors they need to participate.
So the success isn't just about the number of IPOs they attract under these new rules. It's also very much about the long-term performance and maybe the integrity of those companies.
Absolutely. Perception and reality of quality will be crucial in the longer run.
Okay, so let's try and bring this all together. We've seen that this London IPO revival strategy was born out of a real sense of urgency, driven by the pain of losing those major big tech listings to rivals overseas.
Right, a defensive move initially, spurred on by things like the ARM decision and the broader post-Brexit competitive landscape.
And that necessity led to concrete foundational regulatory changes, primarily driven by the Lord Hill Review. Key moves being the adoption of dual-class shares and significantly lowering the free float requirement.
Changes specifically designed to address the demands of high-growth companies, particularly tech founders wanting control.
And the direct payoff, the intended benefit for you listening, is the promise of new, more easily accessible IPO opportunities right here on the London market.
The sources paint a picture of a very active, aggressive strategy. This isn't just about maintaining the status quo. It's a conscious effort at revival, connecting complex global finance competition directly to your potential investment choices.
It shows how deeply intertwined things like post-Brexit strategy, regulatory details, and founder preferences are with the opportunities available to individual investors.
Yeah, the link between allowing founder control via DCS and attracting the kinds of companies that might offer growth potential to retail investors is now very explicit.
So, if the LSE's success really hinges on becoming, or perhaps reclaiming its title as the most competitive finance hub, what does true success look like? That brings us to our final thought for you to chew on. Given that attracting listing volume seems to have been prioritized, partly by reducing traditional investor protections through things like dual-class shares and lower free floats, here's the provocative question. Will the retail investor ultimately bear the hidden cost of this aggressive revival strategy? Or will the quality and performance of the new companies attracted be high enough to justify relaxing those historical safeguards? In 5 years' time, what will define success simply the number of listings, or the quality of protection offered within those listings?
That tension between volume and quality, attraction versus protection, that really sits at the heart of whether this revival will be deemed a true success for everyone involved, especially the retail investor. It's definitely something to watch.